Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. It's Saturday afternoon, March 7th, 2015, and the title of today's very important audio blog is Manipulation Suicide. Now, as you can imagine, I'm literally on fire about this week's developments, which may well have catalyzed immediate commencement of the big one. Yesterday's NFP report was the icing on the cake, and frankly, I'm still in awe of the hubris demonstrated in publishing such a fabricated farce. I mean, I thought last month's report was the biggest economic lie in U.S. history, as discussed in Employment American Style. However, this one takes the cake by a long shot in depicting not just an improving labor market amidst a collapsing global economy, but dramatically so. To wit, Thursday's audio blog was titled The Mythical Services Boom. However, after yesterday's moronic attempt to fool the masses with blatantly fabricated data, even mythical appears to understate the actual reality gap. More importantly, the government clearly misjudged the market reaction to its NFP lie, in our view, committing the equivalent of economic suicide in the process. Frankly, it wouldn't surprise me if, when the history books are written, per the title of my last article, yesterday's NFP botching will be remembered as the catalyst to global financial meltdown, dramatically accelerating the pace that the eye of the post-2008 storm passes over the world. To that end, I have much to discuss, but let's start with the economic and financial market backdrop heading into yesterday's ill-fated NFP report. Throughout the week, no less than 4 central banks lowered interest rates, starting with the PBOC last weekend in a desperate attempt to slow the bursting of its historic real estate construction and credit bubble. And frankly, I'm not sure what's more terrifying for global fiat currency holding denizens, the PBOC trying to stave off its historic bubble implosion, or the Indian Reserve Bank lowering rates mere days after receiving government permission to target inflation. Regarding the former, when the Baltic Dry Index is hitting all-time lows, going back to its inception 30 years ago, make no mistake, it's China that's the principal deflationary force behind it. This is why fully loaded tankers of oil are circling the planet as we speak, desperately seeking ports to offload, but unable to find them, and thus why a return to last month's oil price lows, and potentially far lower, is not only likely, but a virtual certainty outside of an extremely unlikely, extremely major geopolitical event. The lack of Chinese demand is utterly strangling the world in said deflation, and consequently central banks, including their own, are maniacally printing money in a vain attempt to stop the unstoppable deflationary tsunami of reality. To that end, it's even fostered the impromptu launch of a not-so-discreet U.S. government-led oil PPT, which in the past month has become as pervasive and blatant as the also U.S. government-led gold cartel. Watching them desperately protect the $49 to $50 per barrel WTI levels since Wednesday's horrific all-time high inventory builds to all-time high levels, particularly following yesterday's historic rig count and commodity plunge, their level of panic could not be more evident, let alone in attacking paper precious metals as in the fall of 2008, when they were terrified of the historic safe haven status being rekindled, which of course occurred anyway, and as we speak is occurring throughout the world as the ugliest, most ominous currency collapse in global history accelerates. In its wake, said central banks are committing their own forms of manipulative suicide and taking the draconian, counterintuitive step of reducing interest rates as their currencies are collapsing, or in the case of Brazil and Ukraine, raising them because their currencies are plunging too rapidly. Anyhow, heading into yesterday's ill-fated NFP report, global commodity markets were already fading from the mild, pathetically weak dead cat bounce experienced in February, which was stopped cold at its 50-day moving average. WT oil's PPT-inspired surge from $43 a barrel to $52, and Brent crude's from $49 to $63, was the principal reason for the fabricated commodity rebound. However, outside crude oil and the continually enigmatic, blatantly manipulative support of copper, which similarly rebounded, despite all other base metals achieving new multi-year lows, Nearly all other commodities remained in ugly trends throughout the month. In fact, as discussed in the blog earlier this week, the all-important lumber market, which better than any other signifies the true state of the housing market, is not just falling, but plummeting in 2008-like fashion. In the U.S., lumber prices peaked with the housing market's secondary post-2008 peak in mid-2013, which I remember well, as for a few short weeks, my neighbors were excitedly speaking of rising prices. However, since then, lumber prices have inexorably plunged, as exhibited by the CME's lumber contract falling from 410 in April of 2013 to 340 at the end of 2014, or 17%. However, in the last 2+ months, it has really accelerated downwards, closing yesterday at 281, or 17% below the year-end 2014 level. In other words, if you think the recent weakness in home sales, permits, and starts has been ugly, you ain't seen nothing yet. Let alone if yesterday's hideous manipulative suicide causes interest rates to rise further, before inevitably the long-awaited Yellen reversal forces the Fed to unleash an historic, overt QE torrent. Meanwhile, as the historic front-running of ECB QE, which starts Monday, as in the next 2 days, was causing the stocks and bonds of hideously insolvent, recession-mired European markets to soar, and the US PPT was goosing the Dow Jones propaganda average as relentlessly as its precious metals cartel was suppressing gold and silver prices, the unprecedented across-the-board collapse of global currency markets was accelerating dramatically. As noted above, both Brazil and the Ukraine were actually forced to desperately raise rates this week to stave off burgeoning hyperinflation. And otherwise, nary a currency in the world held their value as the flight to the liquidity of the dollar, which I emphatically predicted 15 months ago, became increasingly panicked. Nowhere is this more evident than in the euro currency utilized by more than 600 million global denizens, whose historic collapse accelerated after the so-called deal struck with Greece 2 weeks ago. At the time, I mocked the deal as having absolutely no substance whatsoever. And in those 2 short weeks, not only are in the 2 short weeks since, not only are the Greek people on the verge of all-out revolt, but the beleaguered, debt-ridden nation appears to need a new 50+ billion euro bailout in short order, perhaps within weeks. Consequently, the pace of euro implosion was taking on epic proportions before yesterday's historic crash, with the key low of 1.11 per dollar, last achieved in the ultra-thin Sunday afternoon conditions following Syriza's January 25th election victory, breached in real trading on Thursday afternoon, before yesterday's historic plunge to 1.085 to the dollar, yielding a 2-day collapse of more than 3%, 11% since year-end, and 22% in the last 12 months. To that end, the global currency and commodity conflagration, ignited by yesterday's NFP manipulation suicide, was a sight to behold, with fiat toilet paper the world round achieving multi-month, multi-year, and in many cases, all-time lows against the dollar, unquestionably igniting a new, potentially terrifying, destructive phase of the final currency war we first discussed 2 years ago, which not only destroys companies' ability to conduct international commerce and dramatically escalates geopolitical tension, but as I wrote last year, is the single most precious metal bullish factor imaginable. Whether speaking of the so-called economic leaders known as the BRICS, or full-fledged banana republics, nearly all currencies are plunging against the dollar, many in free-fall mode. To wit, I have long discussed how the virulent inflation exportation, symbolizing the endgame of history's largest fiat currency Ponzi scheme, commenced in late 2011 when leading Western central banks realized their haphazard post-2008 money printing machinations weren't working. It was at that point that the real money printing explosion commenced, along with historic market manipulation, economic data manipulation, and financial propaganda. Since that time, the average global currency is down more than 40% against the dollar, which is why the deflation caused by historic global overcapacity is not translating to reduced costs of living, and in many nations, the polar opposite. And nowhere is this more evident than the so-called Fragile Five nations where a quarter of the world's population resides, i.e. India, South Africa, Turkey, Brazil, and Indonesia, whose currencies on average are down a whopping 49% over this period, with such implosions accelerating dramatically in the last 2 months. In fact, the so-called dollar index hit a new 11-year high of nearly 98 yesterday. In my view, en route to an all-time reading above 120 as the global currency contagion explodes in the coming years, and potentially far sooner. And unlike the last time it hit 120, at the peak of the global economy at the turn of the century, it will be doing so now as the world enters its singularly worst economic environment since the Great Depression, which frankly will likely be remembered as the good old days when all is said and done. And remember, the principal component of the dollar index is the euro, which inevitably will collapse, and under the worst case scenario, as soon as in the next 12 months. Even Maestro Greenspan admitted yesterday that the euro would likely collapse without an accompanying political union, which, given the meteoric rise of anti-austerity, anti-euro parties like Greece's Syriza, France's National Front, Italy's Five-Star Movement, and Spain's Podemos, has about as much chance of occurring as a snowstorm in hell. And by the way, the term dollar strength will take on a whole new horrifying meaning when the PBOC inevitably devalues the yuan, which it clearly must do to prevent China's collapsing bubble to continue at a light speed pace. For several weeks, I've spoken of the potential for such a big bang to take the final currency war to the nuclear stage, as said dollar explosion is causing Chinese manufacturing competitiveness to rapidly collapse, particularly against its political and economic arch-rival, the Japanese, given the PBOC's suicidal peg to the dollar. Ironically, the yuan's dollar peg is the polar opposite horror experienced by the morons at the Swiss National Bank earlier this year. As in the Swiss case, their ill-fated suicidal peg with the euro was broken by Swiss fears, rightfully so, of being dragged into the abyss of a collapsing euro. Meanwhile, the Chinese are equally fearful of being dragged into the currency stratosphere by an out-of-control dollar explosion, which for all intents and purposes will be equally damaging. Only in the Chinese case, when they in fact do depeg the yuan, which with each passing day, informal trading of the unregulated offshore yuan is increasingly signaling, it will have horrifying global ramifications. And frankly, horrifying is about as powerful of a use of euphemism as one can imagine, given how its predatory impact on global trade would be so engulfing, it would potentially morph the final currency war into World War III. Back to today's principal topic, I'm still in awe of the utter lunacy of the manipulative suicide that was yesterday's historically fraudulent NFP employment report. To that end, my initial audioblog title was Lunatics Running the Asylum, depicting not only how chaotic and spiraling the U.S. economic situation has become, but the utter insanity of the equivalent of monetary witch doctors being put in charge, and pure unadulterated morons pulling the strings. I mean, let's face it, the sole goal of today's powers that be, which to be more specific includes the U.S. government, the Fed, and the bankers and corporate titans that decide on policy via unprecedented lobbying power, has one goal and one goal only, which is to kick the can as far as possible by doing whatever it takes, unethically, illegally, or immorally, to support the paper financial markets they own the vast majority of. To that end, since the aforementioned point of no return in mid-2011, which by the way is the title of an article I wrote on that topic, said powers that be have completely and utterly commandeered financial markets, economic data, and for the most part, the financial media. Let alone since the fateful closed-door meeting between Obama and the top two big-to-fail banks on April 11, 2013, after which manipulative events like the Dow's dead ringer and Gold's 2:15 a.m. and Six Sigma algorithms became, for all intents and purposes, daily events. Anyhow, given said mandate, logic would have expected, at best, an inline NFP report yesterday, or better yet, slightly lower than expected. After all, global economic data, including U.S. data, other than those depicting the aforementioned mythical services boom, has accelerated lower in recent weeks, as symbolized by last Friday's historic, unexpected plunge in the Chicago PMI index from 58 to 45, i.e., a level last seen at the heart of the worst economic crisis of our lifetimes in October 2008. To that end, I yesterday updated the real data spreadsheet I initially created last year, listing the change of actual empirical data including durable goods, factory orders, construction spending, industrial production, retail sales, consumer spending, motor vehicle sales, and the labor participation rate over the past 4 months. On average, these data points have declined by 0.7% since September, whilst the BLS has reported the strongest job growth data since before the 2008 crisis. Heck, even Island of Lies diffusion indices like the Chicago PMI have been weakening, and even those that haven't have still reported weakening employment components, particularly those focused on real economically productive categories like oil and gas development. In fact, if one were to simply rely on such data, let alone similar data from overseas, even the most jaded establishment propagandist would assume we were deeply mired in recession, or better yet, depression. Irrespective, given the apparent vice-like grip the powers that be currently have on key markets like the Dow Jones Propaganda Index average, the German DAX, the Japanese Nikkei, and most sovereign debt markets, it's nearly certain that the aforementioned in line, slightly worse than expected, or even slightly better than expected NFP report would have produced relatively static stock, bond, currency, commodity, and precious metal markets, thus kicking the can through another week. Which is why, in all my 25 years of market experience, and 13 of specifically analyzing data, media, and market manipulation, I cannot for the life of me figure what could have possibly motivated them to so blatantly and suicidally publish such a ridiculously, quote, better than expected number. Not that, as usual, even a cursory perusal of the report wouldn't reveal the same horrifying internals as usual. However, said internals have been largely ignored for years on end, and thus, if they had only published, for example, a gain of 230,000 jobs instead of 295,000, with the identical horrible internals, they could have avoided yesterday's carnage entirely, validated what Janet Yellen said last week when she delivered the most unequivocally dovish FOMC statement in memory on Capitol Hill, and kept the brain-dead MSM and clueless money managers focused entirely on the Fed's implicit ZERP to infinity guarantee. As it happens, here's what the Bureau of Fabricated Labor Statistics reported. Starting with the downward revision of last month's supposedly better than expected 257,000 jobs to just 239,000, which, by the way, would have simply met expectations last month and likely not enabled the cartel to brutally slam gold and silver, which of course they did. But why worry about the past, as in today's rigged world, the cartel gets to smash precious metals when economic data is, quote, better than expected, and not allow them to cover when it turns out said data wasn't actually better than expected. Next up, and most incredibly, they followed up the farce that turned January's massive real job losses into a fabricated 239,000 job gain by claiming an additional 295,000 jobs were created in February. Damn the fact that February's economic data was worse than even January, including the biggest weekly jobless claim surge in 10 months. And don't forget the all-important headline unemployment rate, which plunged from 5.7% to 5.5%, despite the labor participation rate again falling to within 0.1% of the 38-year low it has hovered around for the past year. Moreover, the much-hyped average hourly wage figure barely rose, missing expectations and sorely disappointing a street and Federal Reserve desperate for evidence of expanding real incomes, even if created solely by modest increases in mandatory minimum wage rates for people working part-time, non-benefit accruing positions at McDonald's and Walmart, which, by the way, is mostly people who are over 55 these days who can't afford retirement. Now, even if you actually believe 295,000 jobs were created, which they weren't, they didn't even compensate for the 354,000 people leaving the labor force. Or for that matter, that not only were more than half the new supposed jobs in the lowest paying categories, but 132,000 were but figments of the BLS's birth-death model imagination, which consistently assumes net small business formation amidst the worst economic environment of our lifetimes, the most onerous, expensive regulatory environment, and the sheer dominance of megacorporations. And oh yeah, continues to ignore the giant pink elephant in the room i.e., that U.S. small business ownership and formation is at an all-time low, and small business dissolution at an all-time high. Last but not least, the waiter and bartender revolution apparently reached an 8-year high in February, as a supposed explosion of restaurant and bar hirings paves the way to limitless prosperity and Fed rate hikes. Oh wait, did I say last but not least? Sorry, but perhaps I forgot to add this last data point, as it is so least it gives new meaning to the concept, which is that for the second straight month, the BLS assumed essentially zero job losses in the oil and gas sector, despite the largest ever rig count plunge and countless layoff announcements from major oil companies and oil service contractors. But don't worry, if the BLS says 295,000 jobs, no matter how pathetic such jobs are, it must be true. I mean, why would they lie? As they were caught doing after the October 2012 NFP report, when a former Census Bureau worker admitted he was told to fabricate jobs ahead of Obama's November 2012 re-election vote. Anyway, in the report's wake, all hell broke loose. To start, the aforementioned currency collapse, led by the euro but encompassing essentially all global toilet paper. Next, the ongoing commodity collapse accelerated, with the CRB index now within barely 3% of its 2008 spike lows. Stocks, PPT notwithstanding, let alone the announcement that Apple will join the Dow, fell more than 1.5%, which for the PPT is the equivalent of a 3 or 4% decline in any other stock market. And most importantly, the canary in a coal mine that has been the recent surge of the benchmark 10-year Treasury yield from last month's nearly all-time low of 1.64% to yesterday's 2.11 close, accelerated further by rocketing up to 2.25% by day's end. Why on earth it was rising in the first place, albeit from its own historic lows, whilst the rest of the world cumulatively hit a 5,000-year low, and no, that's not a typo, is beyond me. Nevertheless, horrible internals notwithstanding, the so-called market viciously hammered U.S. Treasury bonds, as said suicidal manipulation clearly awakened the bond vigilantes to expectations of a mid-2015 rate hike, even if only by a measly 0.25%. As longtime readers are well aware, no one is less conspiratorial than myself, as without empirical evidence, or at least a preponderance of evidence, I refuse to speculate on events that don't fulfill the simple concept of Occam's razor. However, watching rates rise following Janet Yellen's historically dovish statement last week, let alone ongoing collapse in global economic data, including ours, and a rapidly escalating Greek crisis, it's hard to make the case that, quote, someone doesn't know something about very wicked things this way coming. And if that wicked something involves higher rates, let alone if purposefully orchestrated, it will unquestionably take down the entire global economy, most of the global banking system, hundreds of heavily leveraged derivative exposed financial institutions and central banks, millions of insolvent holders of adjustable rate loans, and last but not least, dozens of insolvent, debt-laden sovereign nations, many of them, like the United States, which put themselves in suicidal duration traps, per the name of another past article, by shifting the preponderance of their borrowings to the short end of the yield curve, thus exposing maximum exposure to interest rate risk. For example, in a country like the US, with its $18 trillion of national debt, each 1% interest rate increase will rather quickly translate to a nearly $200 billion increase in the national deficit. And then there's precious metals, which following a week of the most maniacal capping and attacking in memory, were mercilessly mauled following the aforementioned travesty of a jobs report. We have been observing this pattern of perception-altering manipulation for more than a decade. However, yesterday's was particularly egregious as it comes in an environment of soaring global PM demand, plunging fiat currencies, and as I wrote of last week, a set of mining earnings reports that unequivocally intimated the arrival of peak gold and silver. Let alone as we are within weeks of a new Beijing fix in China, which could in time rightfully transfer the gold and silver price discovery process to points east. And oh yeah, this coming Monday's official launch of the potentially cartel-breaking Apple Watch, which I look forward to the details of with bated breath. However, to truly understand just how close the mining industry is to outright implosion, As evidenced in my article earlier this week, PDAC, the epitome of mining ineptitude, one must realize that nearly all junior miners have either been bankrupted or are on the verge of such, that no major discoveries have been made for more than a decade, and that many of the majors themselves are, if not on the cusp of bankruptcy, dramatic draconian operational and spending reductions. This is exactly what I anticipated in my 2015 predictions, i.e., massive mining industry paralysis, which, after the past month's maniacal cartel raids, is all but assured. To wit, take a look at yesterday's performance of the Huey Mining Index, comprising the world's largest mining companies, which, as I noted last week, all reduced their reserves at year-end for the second straight year and cumulatively anticipate lower production in 2015 than 2014. I also noted how several companies, such as Kinross and Coeur d'Alene, appeared to be just one write-off from bankruptcy, as well as the entire South African gold mining industry, which, aside from a handful of legacy giants, is the gold industry equivalent of high-cost shale producers in the oil and gas business. Even evil personified itself, Barrick Gold, only escaped bankruptcy last year with a massively dilutive equity offering and just announced that not only is its production anticipated to plunge for years to come, but its top 2015 priority is reducing its $12 billion mountain of debt, which, putting into perspective, is barely above the dying company's $13 billion market cap. Just how close is precious metal mining to complete and utter implosion? Well, consider what analyst John Kaiser said at last week's PDAC conference, validating what I said nearly 2 years ago in the junior mining sector, which was already collapsing when I left it to join Miles Franklin in October 2011. Quote, 717 companies have negative working capital, 291 have less than 500,000, and 554 have between 500,000 and 20 million. And nota bene, this is me speaking, my guess is the majority of between 500,000 and 20 million are far closer to the low end of that range. Trust me, I worked 5 years in that horrible mining industry. That money disappears rapidly, and when balances get that low, essentially all of it is used to simply keep the doors open. Back then, the only capital available was from vulture-like Canadian investment banks, naked shorting companies into oblivion in order to saddle them with the worst imaginable warrant-burdened financings. But today, even that piddling capital no longer exists, the product of nearly 4 additional years of relentless cartel naked shorting. Heck, the junior mining investor relations business I worked in, for all intents and purposes, has ceased to exist, and thus with no cash, no ability to market one's company, and for the few companies that still actually operate, no willing buyers of projects. It's entirely conceivable the industry product pipeline has disappeared forever, just in time, I might add, for the inevitable explosion of global demand. And as for the Huey itself, it has plunged well below its 2008 spike lows, to levels not seen since 2003, when gold and silver were roughly $350 an ounce and $450 an ounce respectively. Worse yet, of the 16 Huey components, 7 are below $5 a share, including 3 below $3 a share and 1 below $2 a share. Yesterday alone, 3 Huey components were down more than 10%, and another 9 between 7 and 9%, as clearly investors realize the PM mining Armageddon I've long predicted has arrived. This is why I have spent the past 4 years vehemently warning of the risks of speculating in mining shares, as not only is PM mining one of the world's riskiest, most difficult business to start with, but under relentless, murderous attack by the gold cartel. In other words, they are decidedly not proxies for precious metals, and as far from the actual metal one needs to protect themselves as can be imagined. Holding the metal, none of such risks are assumed, and the more the mining industry implodes, the better the outlook for physical prices. To that end, and particularly in light of what appears to be a re-escalation of history's broadest, most global currency collapse in history, I cannot emphasize enough how imperative it has become to protect your hard-earned savings with real money, as in the long run, physical gold and silver always protect wealth. And if you decide to take action by buying or storing precious metals, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks very much.